The widespread belief that emerging markets are entering an AI-fueled supercycle is actively mispricing risk across the entire asset class. Investors are buying an index that masks severe geographic decay. A surge in North Asian semiconductor exports provides no external financing for disconnected frontier nations. The emerging market debt spread has compressed to 243 basis points. Wall Street is trading a compositional average that hides the underlying sovereign reality. Just two countries, Korea and Taiwan, accounted for more than 90%. The external funding structures that support high-yield emerging market debt have suffered two critical fractures in just 8 days. Japan sharply revised its inflation forecast to 2.8% and intervened in currency markets, while the ECB signaled a June rate hike. When both funding currencies tighten, carry trades supporting frontier duration face structural pressure that a 243 basis point spread fails to capture. Trump's rejection of the Iranian peace proposal, followed by presidential briefings on renewed strikes, points to a prolonged closure of the Strait of Hormuz, sending Brent crude to an intraday high of $126 per barrel. This creates a compounding fiscal shock for energy importing markets like India, where high prices and monsoon weakness invalidate the IMF's base case projections. This line chart maps nominal versus real IT investment, showing the gap widening since early 2025. JP Morgan data reveals that rising input costs are now eating into the hardware capex cycle, causing the North Asian tech premium to fade. The EM index is caught in a dual squeeze. The hardware proxy loses its margin efficiency, while the frontier tier breaks under the weight of geopolitical energy costs. Surviving this environment requires breaking the asset class in half and trading the extreme bifurcation within the index. Position long on hard currency debt from Latin American and African commodity exporters, like Angola and Venezuela, who directly capture the attrition dividend of sustained energy spikes. Maintain strict caution on energy importing Asian frontiers, avoid carry structures funded in yen or euros, and prefer hard currency over local sovereign debt. Portfolio safety and alpha are found in structural energy exporters. The homogenized emerging market index is no longer a viable proxy for value. Capital markets remain open, but only for the specific credits aligned with this new macroeconomic reality. Bypass the rigged index system. Access the unredacted briefing to acquire the tactical allocation blueprints required for this regime.